is Preethy Padmanabhan. I'm the host and founder for 10x Growth Strategies podcast and events. Today, we are featuring a VC Insights panel focused on fintech. And we have an amazing set of panelists here. I pass it on to Schwark to introduce himself.
I'm Schwark Bhargavi, general partner at Trinity Ventures. The early stage firm, primarily Series A's and B's. I focus primarily in fintech, DevOps, and so from the DevOps actually end up being much of AI stuff. My background primarily is as an entrepreneur before I became a VC. Started a couple of companies, one that was called Yodely back in '99, which was one of the earliest fintech companies before it was called fintech. And then started a second company called TrueAccess. So Yodely went public, TrueAccess restored to MasterCard. And I also spent some time at some public companies like LifeLock as an exec at MasterCard.
So you invented fintech, Schwark.
I don't know if I'd say that, but I was doing stuff where nobody else wanted to do it. So
Excellent. Bhargavi?
Hi everyone, good evening. Good to be here. I run a venture capital fund called Java Capital. We invest at pre-seed and seed stage in startups, and I'm a finance professional by qualification. And I used to work in corporate finance, worked across different industries in automotive, in pharmaceuticals and consumer products. Have seen some tech implementation of financial organization and functions in these organizations when we moved from Excel sheets or integrated Excel sheets with some early products. And I was briefly a fintech entrepreneur myself. This was before the advent of AI, where I tried to build a virtual AI CFO for small businesses and startups before I became a venture capitalist.
That's great. That's a good segue to my next question. What inspired you to start Java Capital?
So I had my firm where I worked with close to 30 small businesses and startups, acting as their CFO, and that prompted me to build the ZI enabled assistant. Uh, and my co-founder, after working in this, we raised this once round for around 1.5 years. We worked on it, and then he found it too boring to continue to work on this, and he moved on to crypto. And I ran an accelerator. By then, I had already invested in 20 startups as an angel investor. And I felt becoming a VC is probably a natural progression, and I like doing it. And I can probably support more founders being a VC. So I set up Java Capital in 2020. Have been running it for the last 5 years. We are on to our third fund now.
Exciting, exciting. You did you do crypto investment? Oh,
Not yet. Snapheads. I'm all about boring side of finance. So if you are looking at how AI can help in non-regulated businesses, somebody asked, I know how AI can help in the corporate finance side. This is generally considered boring.
yeah. Schwark, you decided to go from an entrepreneur route to join venture capital. Tell us your journey and what inspired you to do that.
So I have to say, I actually didn't want to do it. Uh, I was a committed entrepreneur, wanted to go start my third company, but the firm Trinity was actually an investor in my second company, and they approached me and said, "Look, we're trying to start a fintech practice, and given your background, that'd be great to work with you if you're willing to come work with us as a partner at the firm trying to do investing." For a long time, I actually had to struggle with it to say like whether you want to do this or not. Ultimately, my partner Ajay actually convinced me that this is actually the better way to create more amount of impact across most number of entrepreneurs, and so I mean,
Well, we're glad you did that and you're sharing all your insights here. Well, 2021, 144 billion. 2023, 42 billion. 2024, 34 billion, right? That's the amount invested in fintech. And we are seeing this rapid decline. Tell us, what is your outlook for 2025? We'll start with you, Shra.
Yeah, I think you know any big set of innovations starts with a bubble. I mean, this happened with the internet in whatever the late '90s, early 2000s. Then that bubble burst. But if you think about all the big internet companies that exist, they didn't actually come out of the bubble. They actually came out of the 10 years after that, when the internet became foundational to kind of build a lot of other businesses on top of it. Same thing with mobile and so on and so forth. So every one of these things creates a bubble of different, explosion of investing and companies that also grow very big and then also die very fast. But then that creates a foundation that's necessary to do a lot of innovation decades into the future. I think fintech went through its bubble phase in the last 2 3 years, which is a good and a bad thing. It's a good thing that there's a lot of infrastructure needed to do innovation in fintech that actually got established because of that bubble. There's a lot of companies that got funded and probably collapsed in the process, but that's the part of how sort of has been built over many decades. So I think it's not necessarily a bad thing. But what that means though is that by the way, one other thing I'll add is there was something unique about the 2020 to 2022 timeframe, which is we had near zero interest rates. What that means was capital was extremely cheap, and so you could do things that were extremely capital intensive that I don't think will be possible anytime in the near future, at least, unless the rates go back down to zero at some point in the future, which doesn't look likely. So so what that means is there's a lot of direct to consumer stuff that got founded. And the direct to consumer stuff is extremely capital intensive. And in most cases, it's just impossible to do, right? But they managed to do it. They managed to do it because the capital was cheap enough and easy enough to raise. And that actually led to that, whatever, 140 or $200 million of $1 billion of investing that happened. So I think that a lot of that was really powered by what I call cheap money. I don't think that'll happen. But that contraction is not necessarily a good indicator of this stuff actually becoming out of favor. It is more about it's becoming more normal, right? And so if you think about a couple of things have happened. One is I think if you think about 2025, I don't think you're really going to look at a lot of companies that are trying to do again direct consumer type stuff. For the same reason, because capital is not cheap anymore and trying to go down that path requires a lot of capital. So those are not the ideal kind of things to be spending time on right now. But if you think about what those first set of direct-to-consumer companies did is set a set of expectations with consumers that basically says things could work a certain way. They demonstrated what was possible. Now, what that means is now the consumer expectation will kind of demand that of everybody else in the ecosystem. What that means is, Chase and Wells Fargo and everybody else needed to go and put a lot more effort and energy into modernizing their tech infrastructure. In fact, JP Morgan actually announced that they want to spend around $40 billion until the next 3 years in modernizing tech infrastructure. So I think there's going to be a lot more interesting opportunities with just powering the rest of the national infrastructure to modernize, which I think there's a lot more, pressure to do. And the other big thing that's actually happening, of course, is AI. There's a lot of things happening because of AI. I think there's a little bit of discussion in the prior panel about how AI may or may not work in regulated industries. That's true. I don't think AI will actually be able to kind of make an impact on things like underwriting or fraud even, because I think the regulatory frameworks actually can be quite onerous there. But they can make a massive impact on potentially making applications available to a category of people that might not have been possible before. Um, so what AI can do is basically kind of personalize the advice or the feedback or whatever the financial products down to a individual without actually building for each particular individual. When we built software in the past, if you want to serve a certain subsegment or category, you have to build software for that category. And whether the size of that category determined whether or not it was profitable and economical to build that. Today, I think it's probably more possible to serve a much broader audience in ways that are actually economical. So you can actually start and see a lot more kind of applications that will be possible.
Absolutely. No, I think I love the positive outlook there. It's like a just a reality check, right? What happened in the past with the bubble and now it's stable. That's what I'm hearing from you. So there's opportunities for true entrepreneurship, true innovation to happen. Bhargavi, would you like to add your thoughts on both the whole, what is the future of fintech in 2025 and any AI and what does it mean for fintech?
Sure. So I think 2025, as Schwark said, is going to be more quality than quantity. And we are seeing the consolidation, which is good. One anecdote is I was there in Sasta last year, and the booth which was taken at the first time I saw around probably three bays taken up by fintech companies in Sastre. And companies are operating mostly in corporate finance side, but in different domains under corporate finance side, which I think to a large extent was enabled by AI, which was not possible before. I think that is one area where I think there is a lot of white space, and we will continue to see some winners coming in. And couple of other sectors which I'm excited about and which I'm seeing is one is cross-border payments. There is a lot of activity which happens, and I personally think that has again been a neglected side. And now with technology enablement, and that is another area where there is a lot of opportunity. I think these are a couple of areas where I'm quite bullish on, where there is scope for innovation to come up in fintech.
Absolutely. I think you bring up a very good point, and I love that we're getting different perspectives on this panel, right? We go to India, we go to Europe, you're using different payment methodologies, and how do you make that an equal playing field? And so many areas of innovation that could happen there, in terms of payments and all that different angles. Let's talk a little bit about all the entrepreneurs here in this audience. We have early stage entrepreneurs and over here. What would be your advice for those who are looking to pitch to you and in order to like what are the best foot forward? Maybe we start with you, Vaidi.
Sure. So I think one general advice to any entrepreneur looking to raise their first capital is do your homework on which doors to knock. So be it with respect to sector focused VCs, stage focused VCs, it's very important that you approach the right track of VCs for your current stage of fundraise and sector. And that's going to save a lot of your time when you do your homework before you actually start the pitching process. When it comes to us, specifically on fintech, I think fintech is still a domain where it's important that founders demonstrate uh, deep knowledge on what they are building and why they are building and how will they hop jump the hurdles that could come up in this particular sector. So I think that is something founder market fit, or the founders demonstrate their ability on they know who are they building this for and why are they building and why are they the right people to build this. I think that's something which would be very important to see, specifically in this particular sector.
Sounds good. Well, you can talk about what are some qualities and red flags that you look out for when entrepreneurs pitch to you.
So I think one thing the bio talked about is that founder market fit is probably the biggest thing. They're trying to see why is it that this team should be going after that idea, right? Because the the big realization that I had as an entrepreneur myself and also as a VC is that ideas are cheap. Like there's a million people that perfectly have the same idea, right? Execution is where battles are won and lost. So the question is there something that basically gives this team some edge in winning the market because they're really going to win that execution there, that they're going to out execute everybody else in the space? Oftentimes, that comes down to having some kind of unique insight that comes from, again, like what you said, a deep understanding of a specific space in some ways. So you understand that space, you understand that problem in some inherent level that gives you that unique perspective that might be, differentiated and therefore gives you the edge to actually out-execute anybody else.
Makes sense. Keep your questions ready. We will come to that shortly. But before we do that, question to you, Shwar. How do you identify unicorns?
I wish I knew. Uh, so I think, all of us are always searching for that, the hidden thing with unicorns. And ultimately, the thing what I would say is that, so we actually did some analysis at our firm to try and see which of our investments did well, which of our investments didn't do well, and look back to see what we as a firm can learn from that to see if we can apply that, more effectively going forward. One of the things that struck me, which maybe is not all that, controversial, but it at least was interesting to me, is that the deals that were the most contested, where different partners in the organization were on either side of the fence. Like there was not consensus whether this company will actually work out or not. Those are the companies that actually end up being the outlier performance. It is not the ones that everybody said, "Oh yeah, this one we love this company. This one's definitely going to work," or the ones that everybody said, "Oh, this one sucks." Like those things tend to not be performers, even the ones that everybody thought were going to win. But the ones that half the team thought was going to be a disaster and half the team thought it was going to be an outlier, those ones actually ended up being outliers. And I think part of it is because if you think about what makes unicorns, I think it is that they are creating something that is not obvious when they start, but they have the potential to do so. So that's why you have this split between the partners where some of them are looking and saying, well, clearly this doesn't exist, right? I mean, we famously walked away from Uber, right? And we look back and we're like, okay, after people said like, black cars, really? I mean, this was a black car company at the time, right? So we're like, really black cars? It doesn't make much sense. Or somebody else said, well, it could be something else, right? It could be so much more over time. This is like the starting point. Now, those kinds of things where somebody is very, very practical that says this doesn't work, and somebody can actually dream and say, well, I can see with one eye closed that this thing could be something different, right? And then you have to have a founder or founders that are really good at executing on that one eye closed vision, right? To say that big thing can happen. If you have that dichotomy of basically that this probably won't work, but if it does, it could be a market creator, coupled with a founding team that has the ability to capture and execute on those opportunities, oftentimes creates the inverse. But having said all that, I'd say that our track record of finding the unicorns continues to be just like everybody else, not all that great.
Well, that's great. Actually, I'm reminded about 20 years ago when I first started doing these events and, starting the whole event journey in Bay Area. I heard Guy Kawasaki say the same thing, wherein you actually have to elicit emotions, right? Either love or hate from your product. If some people love your product, and hopefully that's large numbers, millions of people, then you're likely to be successful. Not everybody has to like it. So great, great thoughts there. So, Bhargavi, once you find the unicorn, how do you help a startup to be successful?
Okay, so I don't know if we are finding unicorn. It's hard. As he said, we do have, we don't have unicorns in the portfolio yet, but we do have one of India's latest, fastest unicorn in an anti list. So, which is a secret just between this room. I don't want my LPs to know, but so it's hard. So, we take it, but some helping the founder, I think, being a smaller fund, how it helps the founders is wherever they need help or support, it's the partners who they get to pick up the phone and call and talk directly, right? And why that helps is it's not some second level associate or analyst who considers, I mean, they have 100 other things to do. But for us, we know what is the priority, and it's always there in your head when we go talk to other potential investors or somebody who could come on board as an expert. You know exactly the requirement of each of the portfolio company at that particular point in time. So, um, but I think this broadly what we try to do. But otherwise, to my founders, I say I'll be as involved as you want me to be. So
Sounds good. Let's hear final words of advice or any thoughts you want to leave the audience with.
I think market up and down, all the funding up and down will keep going, and sometimes this is probably the best time to build. As people say, I know it's a cliche statement, but the reason is it's true that you will get good talent coming into the market, looking for opportunities because their opportunity cost is lower probably now. So I think there is no right or wrong time to start your startup when you think it's right, when you think you have everything in your arsenal to understand the problem you are going after and you can build a good solution. You just have to go for it as a founder.
Excellent. Sean?
I guess I can say, think about why, if anybody's trying to think about starting a company, think about why you want to start the company. Because I will tell you that it is the worst way to create wealth. If that's the reason you are trying to go do it, don't do it. But I think the best reason to start a company is you have this uncurable itch that you have to scratch, and you can't sleep because you really want to do something about that specific problem. That's a good way. But that's a good reason to start a company, because I think Bhargavi said there's going to be lots of ups and downs, a lot more downs than ups. Even the company that I took public, we came close to dying 3 or 4 times in that time frame. And you can't keep going in the face of such situations if you don't have some substantial amount of passion for whatever it is that you're trying to do that keeps you going. So,
Right. Great way to finish that session here today. And we appreciate you coming amidst all the events that are happening.